Many American homeowners who refinanced their mortgage over the past few years are now discovering that the long-term cost of refinancing can be higher than expected, especially for working professionals who extended their loan term to lower monthly payments. Over the last several years, mortgage refinancing became one of the most common financial decisions among American homeowners. When interest rates dropped, refinancing appeared straightforward. Lower your rate, lower your payment, improve cash flow. For many working professionals, dual income households, mid career earners, families with children, refinancing felt like a practical adjustment rather than a major financial shift. But the long term consequences of refinancing are rarely discussed with the same clarity as the short term payment reduction. And that's where the financial tension begins. Refinancing typically resets the mortgage clock. If a homeowner refinanced into a new 30-year loan after already paying 5 to 7 years on their existing mortgage, the amortization schedule effectively restarted. That means more years of interest payments, even if the rate itself was lower. In the early years of a mortgage, most of the monthly payment goes toward interest, not principal. This is how amortization works in the United States. When refinancing resets the term, that interest heavy phase begins again. For professionals who refinance to reduce monthly strain, perhaps due to childcare costs, rising insurance premiums, or other fixed expenses, the short term relief was real. But long term interest totals can increase depending on the structure of the new loan. Another overlooked factor is the extension of repayment timeline. A homeowner who originally planned to be mortgage free in 20 years may now face a 30-year horizon again. The psychological impact of this shift is subtle but significant. Instead of progressing toward ownership completion, the financial runway stretches outward. This affects retirement planning indirectly. Many working professionals build their retirement projections assuming their mortgage will be paid off before retirement. A reset loan term can push that milestone further out, increasing projected monthly expenses later in life. There is also the issue of closing costs. Refinancing is not free. Lender fees, appraisal fees, title insurance, recording fees, these costs are often rolled into the new loan balance. That increases principal. When principal increases, total interest over time increases as well. Even when monthly payments decline, total lifetime cost can expand. For homeowners who chose cash out refinancing, the long term cost structure becomes even more complex. Cash out refinancing allows homeowners to convert home equity into cash, often used for home improvements, debt consolidation, or other expenses. While this can reduce higher interest consumer debt, it shifts that debt into a secured, long term structure. Credit card debt might carry a higher rate, but it does not typically extend for 30 years. When consumer debt is converted into mortgage debt, the repayment timeline expands significantly. Another dimension involves mobility. Working professionals often experience career shifts, promotions, relocations, or industry changes. A longer mortgage timeline can influence housing decisions later. If housing markets shift or rates rise, refinancing again may not be attractive or even possible. This creates a subtle form of financial inflexibility. There is also the impact of rising property taxes and insurance costs. Many homeowners refinanced focusing on principal and interest savings. But in recent years, property tax assessments and homeowner insurance premiums have increased across many US regions. Lowering the mortgage rate does not control these external housing costs. As a result, total monthly housing expenses may rise again, even after refinancing. This creates a financial pattern: short-term relief, gradual cost re-expansion, extended long-term obligation. It is not a crisis scenario. It is a structural shift in long-term cost allocation. Another long-term consideration is opportunity cost. By extending a mortgage, homeowners allocate a larger portion of lifetime income toward interest payments rather than asset accumulation elsewhere. For professionals, balancing 401k contributions, college savings, and healthcare expenses, long-term interest payments compete with other financial priorities. Refinancing decisions are often evaluated based on break-even periods. If closing costs are $5,000 and monthly savings are $200, the break-even point is roughly 25 months. But break-even calculations typically focus only on upfront cost recovery. They do not always account for the extension of total interest timeline. A refinance can be beneficial in many circumstances. Lowering from 6.5% to 3% significantly reduces interest burden. However, extending from 23 remaining years back to 30 years changes the total repayment structure. This is not inherently negative, it is simply longer. For mid-career professionals, time horizon matters. In your 30s, extending a loan term may feel manageable. In your late 40s or early 50s, resetting to a 30-year mortgage shifts repayment into retirement years. That creates alignment questions between housing debt and retirement income. Another aspect involves home equity growth. When more payment goes toward interest in early years, equity builds more slowly. Refinancing resets that schedule. For homeowners planning to sell within a decade, slower equity growth may affect net proceeds. Again, this depends on market conditions and appreciation rates, which vary widely across states. Refinancing is often framed as a rate decision, but in practice, it is a time decision. It determines how long housing debt remains part of your monthly structure. It determines how much lifetime income flows toward interest. And it affects when full home ownership is achieved. For working professionals, housing is typically the largest financial obligation. Adjustments to that obligation ripple outward, influencing retirement planning, savings behavior, mobility, and risk tolerance. When refinancing reduces a monthly payment by a few $100, that liquidity can be valuable. It can stabilize cash flow during high expense phases of life. But the extended horizon is rarely emphasized with equal clarity. There is also behavioral drift. When payments decrease, households sometimes increase discretionary spending. Over time, the initial savings can be absorbed into lifestyle expansion. The long-term mortgage extension remains even if the short-term relief disappears. In regions where home values have increased significantly, refinancing may also involve appraisal reassessments and loan-to-value recalculations. This can shift private mortgage insurance obligations or alter monthly escrow requirements. These adjustments add layers to the long-term cost structure. None of these outcomes are extreme. They are incremental. And incremental shifts are often the most powerful in personal finance. Refinancing decisions taken during periods of low rates made sense in their context. The broader question is how those decisions reshape financial timelines over decades. A lower rate does not automatically mean lower total cost. A lower payment does not automatically mean faster financial progress. Time, structure, and total interest matter. For many American professionals, refinancing was a rational choice in response to economic conditions. But the full impact becomes visible only years later. In retirement projections, in total interest statements, and in extended repayment schedules. Housing debt is long-term by design. When that design is reset, the consequences are long-term as well. The issue is not whether refinancing is good or bad. The issue is how it redistributes cost across time. And in personal finance, time is often the most underestimated variable.